Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perney, and today we are very pleased to welcome on Tyler Vinson, the CEO and founder of REtokens. Today we're going to be talking about something that bridges two things that I would wager to guess that not many people think really could be integrated together, and that is the world of digital assets and blockchain technology with real estate. And especially in the realm of commercial real estate and things like syndications and the like. It's something that I've been really looking forward to interviewing Tyler on because it kind of bridges my love of real estate, my love of technology. So I'm excited to dig into it as well. It's something that, as real estate investors or people that are looking for an alternative way of looking at finance, we certainly all cannot, really kind of shouldn't have been ignoring, but certainly no time if you are continuing to not really give weight to the digital asset space to really kind of look at this stuff and one, understand it from a basic functionality perspective, but also understand how this stuff can kind of migrate into other aspects of our investing lives, right? It's not just saying, hey, I want to buy Bitcoin. Okay, that's great. Digital assets and the technology behind them, especially when it comes to things like blockchain technologies, have utilizations that are very far reaching. People are talking about utilizing blockchain technologies for voting systems, right? It's not just your Bitcoin, your Ethereum. There's a lot of different utilization for this kind of stuff. And today I'm really, really excited to dig into that with Tyler. So Tyler, if you wouldn't mind, give us a little background about yourself and kind of how you came to be in the space, but bridging the gap between digital assets, blockchain, and real estate.
Yeah, absolutely. And thanks for having me, Alex. Looking forward to our conversation here. Yeah, my background is 24, 25 years of investment real estate and being an investment real estate professional. So I've really done it all, anything from flipping houses to holding single family rentals, graduated into multifamily, storage complex, a lot of creative real estate, creative finance, creative deal structure. And then started working with a lot of private investors and got into syndications. And that's kind of the real estate background. As far as the digital aspects, there's, really kind of two sides of that really led me to jump in on the tokenization side. And one of them was just solving my own problem as a real estate syndicator and a real estate sponsor. And as a professional real estate investor over a couple of decades, I would always have a lot of equity. I may have, millions of dollars of equity on paper and locked up in the real estate, but it was very difficult to access. I either had to sell the asset in total or would have to work with the bank to do a cash out refi. And so real estate is pretty much illiquid, right? And so when you run companies and you have a lot of overhead or there's investment opportunities that pop up, it'd be nice to reach in where you have several $1,000,000 in equity and grab out, $200,000 or something to be able to use in the business or for investment purposes. And that really hasn't existed. And then the other side of it was always wanting to be able to get more people involved in the real estate investments themselves. And so when I learned about real estate being put on blockchain or making the ownership digital, which is what we call tokenization, it just really all hit for me. And I really felt like, okay, finally, real estate can participate in the digital era where these private shares of real estate can actually trade like stocks or more recently crypto. And that really led me into REtokens and the directions that we're heading today.
Fantastic. So the thing that, again, we can all appreciate is when investing in, really any type of real estate, with the exception of some financial products that are on, various exchanges, real estate has a multitude of benefits, but liquidity, as far as kind of an expediency or velocity of capital, can be rather slow, right? You have to, if you're selling a single family house, you're not doing it in a day. Selling commercial real estate, definitely not done in a day. And also to the point of, refinancing, especially in the interest rate environment that we're in, although we did see a rate cut today, again, those kind of things take time, right? We've,
Yeah.
probably if you've invested in real estate for any appreciable amount of time, you've definitely run up against being, asset rich and cash poor, right? Not wanting to, a cherry of a deal comes along and you're like, hey, this would be awesome. $1 million in equity, well, it's going to get sniped off by someone else, and the ability to be flexible with that, I think, is something that really hasn't been effectually solved. Maybe up until this point of what you're trying to accomplish with this. So, you mentioned kind of two different buckets, right? And we're going to, expand on both of those. One from a development side is being more on the syndicator or the GP position in these and how tokenization and blockchains can integrate. And then also on the liquidity aspect, right? And the, how to create, these kind of transform these assets into something that is, again, a little bit, or significantly more liquid. But let's kind of dig into the development side, because I think they're probably going to be a little bit longer on the other portion of it. So, from a syndicator's point of view, right? Like, how do you necessarily take something that has been, for decades, really, with some minor tweaks depending on legislative things that have come through, a very paper intensive process, right? You have a prospectus, you have your subscription agreement, you have required disclosures, and these things are big and verbose, and then you have signed documents, and that's what your indicia or your actual tangible investment is on the commercial real estate side of things. So how does this kind of aim to change that? Like, what things are going to be kind of shifting in your model to be able to effectively benefit the developers?
Yeah, yeah, absolutely. And I mean, since we're talking about securities here, I do hold a securities license, so I'm just going to give a light disclosure disclaimer that I'm not giving tax advice or legal advice, or I'm not doing any type of investment offering here, but we're just going to dive into the education of it and kind of the mechanics of how it works. And so, yeah, let's just start with like, what the heck is tokenization? What does that even mean? And what that is it's simply just making the ownership of the asset digital. So when you do a syndication, for example, normally what you're selling is LLC ownership units, or you can call them shares. So those same LLC ownership units or shares, when we give them a digital component, when we make that digital or that ownership digital, that's what tokenization is. And when it's digital like that, we can put it on the blockchain. So what does that do for you? Let's get into that. So as an issuer, there's a few real major impacts. There's a grocery list of benefits, but there's a few real major impacts. One of them is if somebody's out there raising capital, they're normally kind of stuck in okay, I don't want a whole lot of investors in this because there's very manual process, which you just described with all of the paperwork, and you're really limited to kind of your network or what your promotions would be. But when you work with a platform that has the appropriate licensing, you can actually list this in a marketplace and get potentially global exposure. So it's a great way to expand your potential investment pool. And because of the technology that's behind it, it makes it much easier to manage the different investments coming in. And so what we typically see is, instead of these $50,000, $100,000 minimums to get involved, issuers are bringing those minimums down much lower, which allows more people to be able to participate and allows for greater diversification. The other thing is everything's done online. So I'm gonna just kind of geek out a little bit here and talk about what's behind this, since that's kind of where we're going. So to be able to transact like this, right, you needed to have certain things happen in the Jobs Act, and then you needed technology to catch up. So there's something that we call Web3. You don't need to know what that is. It's just the kind of the underpinnings of it. And in this kind of Web3 infrastructure, what we've done and what we've built is a ecosystem or a platform that hooks in all the things that you need to actually transact, from a primary capital raise to actually selling on a secondary marketplace. And so that would be like the transfer agent, that would be like the custodians, that would be like the what we call the ATS, which is the matching engine or the secondary market, escrow accounts. All of these things are hooked up in the back, but it's very much what we call a Web 2 experience for the user, where it's kind of like online banking or kind of like any of these investment platforms. So just the journey, real quick, high level. would be, once we have a strategy meeting with you, for example, and understand, like, do you need to have your securities docs made, or do you already have them? Because these are securities. Once we have security docs, we can mint the real estate tokens. We can create that digital component to it. And then the issuer is able to sell those components, or if they're working with a broker dealer, the broker dealer can help raise the capital there as well. And once you have that digital component, not only do you have that streamline ability, but it opens up a couple doors that have never really been there for real estate before. And this starts to get into the liquidity from the syndicator side. One of them is the ability to list those, not only the GPs, but also all the LPs that are involved, be able to list those on a secondary marketplace where you can trade shareholder to shareholder, right? And they will settle the same day. You got to have a seller and you got to have a buyer, right? But that's that whole matching system that I just explained. And you can actually sell these private shares of real estate at whatever level that you're choosing to do that. Another thing that is not 100% here today in the real estate world, but is in the RWA world, real world asset world, that's coming, is the ability to put up these security tokens, these real estate tokens, as collateral for loans. So normally when you get a loan in real estate, it liens the title and everybody has to play ball, so on and so forth. But in the future, what I think you'll see, and you are seeing in other asset types right now, is actually just using your ownership shares, your tokens, and being able to put those up as collateral and get very competitive loans, again, that often settle the same day. So you've got greater exposure to potential investors in a global marketplace. You have the streamlined efficiency of all the technology and the compliance piece of it. You want to typically work with an SEC registered platform, so you know that everything you're doing is compliant. In fact, those tokens can have the compliance aspect coded right into the ownership. And then, of course, the ability to participate in a secondary marketplace and give the GP and LPs that liquidity component. And that way, real estate, which has typically been illiquid and everybody has to do the same thing at the same time, now has pathways to liquidity where each person involved in the deal can kind of choose their own path, right? When we talk about making those real estate tokens, they now have something a little more tangible than just a place on a cap table. So those are some of the basics when it comes to tokenization.
Cool. So a few things to break down in there, and one thing I'm, always curious because the policy stuff is where I'm one of those few people that enjoys reading policy updates and compliance memorandums. So I tend to nerd out a touch on that. But when it comes to kind of the compliance aspect, because a thing, especially with the world today, and there's certainly people that operate commercial real estate. You see it, every day that, are not operating within the bounds of how they should be marketing and soliciting for these things. So, especially for syndicators, trying to operate in good faith and make sure that you are staying compliant is very important. Something, if we're developing real estate, we should all be putting as kind of, first and foremost. But from the perspective of that you mentioned that it kind of streamlines some things on a compliance aspect, but if these are going to be accredited investor, let's say a Reg D offering, right, and it's not something that's necessarily to the issuance, maybe registered under like a Reg A for a crowdfunding offering that's open to non-accredited investors. How does that kind of play into this? Are there aspects of putting it on blockchain that help with, let's say, an accreditation standard, so that way it's just easier to raise more money, or does it actually kind of bleed into other things that would not necessarily necessitate having an accreditation standard for what's being offered?
Yeah, that's a good question. There's a couple of things there. So I'm going to narrow it to compliance uh, and accredited versus non-accredited investors, and what that means. Um, so REtokens is a tokenization and technology company, REtokens USA, but we have REtokens Capital LLC, which is our FINRA member, our SEC registered broker dealer, and ATS, our secondary marketplace. And so anybody participating in a secondary marketplace like that or working with the broker dealer is required to do things like due diligence to make sure that these deals are in compliance. So they may work with the issuer's attorney. We have our own chief compliance officers and attorneys on staff. And when we create the technology and the platform, it all needs to operate within the bounds of a SEC compliant ecosystem, right? So there are things like, let me give you one example. There's a holding period from when you first do a buy one of these securities to where it can be sold to a non-accredited investor. So there's a preview of coming attractions. And that is a 12-month holding period. And those are resold under something called Rule 144. That's what these are sold in the marketplace, the ATS with. Well, you could actually program into the token that holding period where somebody could not sell that to a non-accredited investor for 12 months, because hypothetically, if they did, that could ruin this entire safe harbor exemption if you're doing like a Reg D or something, some type of exemption to the capital raising. So let's talk about accredited and non-accredited and what that looks like and how more people can get involved. When you normally do a syndication for the first time, you're selling these securities for the first time. Again, we'll just call it a Reg D. In fact, we'll call it a Reg D 506C.
There you go.
Yeah, so only accredited investors can get involved in that. And that we call that the primary market, right? It's the primary sell, it's the first sell, and there's a lot of rules involved in making sure that you comply with this Reg D 506C exemption, and accredited investors only is one of them. However, just like there's an exemption to a primary offering, there's an exemption to resale. And that resale exemption is called Rule 144. And if you follow all the compliance in Rule 144, again, why you probably want to work with a SEC registered platform and a broker dealer, but if you comply with all of that, you can actually sell those to non-accredited investors on a secondary market like an ATS. And that's the whole reason that REtokens Capital LLC really exists and did their business model, was to create this type of marketplace that's just not out there. And so that is how non-accredited investors can participate in these Reg D offerings. There's also things called Reg A plus, Tier 2, and things like that. But again, sticking to a Reg D 506C that's normally accredited only with particular minimums and things like that, when you go to the secondary market, when it qualifies to do that, let's say 12 months later, in the example we're using, both the GP syndicator and the LP, the investors that invest in it, can list their tokens at whatever amount they want and sell those to non-accredited investors. And that is potentially a global marketplace as well. And now just opens up a lot of access. So now you can see that as we get billions of dollars of real estate on chain, as we get billions of dollars of real estate into this secondary marketplace, how that becomes a robust liquid marketplace with a lot of buyers and sellers doing transactions, just as you would expect, from more mature marketplaces, like we've used example of the stock market or more recently crypto. So that is the primary market, the secondary market, accredited investors, non-accredited investors, and how we use those exemptions to be compliant, and how our tech and our licensing is kind of the backstop to make sure that that everybody's doing business the right way.
Gotcha, cool. And then from the aspect of kind of again where the dollars kind of interact with this, right? Is it something similar? Because just digital asset space, there has to be some type of fiat conversion, right? Is the process basically similar for a syndicator or a capital raiser to where the real estate purchase, right, is still kind of done? You raise the capital, and then once everything is fully funded, then the conversion happens to a tokenized asset where the essentially the the units are minted onto a specific like Web3 blockchain, and then everyone gets issued those tokens. Is that basically kind of how it works in that regard?
Yeah, it's a good question. Let's unpack it a little bit. So when we tokenize and give it that digital aspect, we're just digitizing that ownership component that's already there. Because fundamentally, this is still real estate. It still takes great operators, great properties. It's still based on net operating capital and all of these things. We're just adding this digital component to the fundamental real estate. So typically, it's just going to be a fiat transaction. And in that infrastructure that I described earlier, each person has an account, or you can call it a wallet. And these are multi-asset wallets or accounts, meaning they can hold fiat, they can hold crypto, etc. So this is how that works. A regular transaction would be somebody is either selling their real estate token, or they're selling their real estate token. That can be primary or secondary. And somebody comes in with fiat dollars out of their bank account, and they buy that real estate token, and now they hold it in their account. You can, through markets that are licensed to do so, like the REtokens Capital one, use like Bitcoin or stable coins now is a big thing, like USDC. And you could off ramp from crypto and purchase these real estate tokens, these real estate security tokens. Now, as somebody selling those tokens, very often, certainly in the primary, you normally want and need fiat to do your acquisition, to do your development, to operate, right? And so, yes, the custodian that we use does a conversion from the crypto to the fiat, and that all happens behind the scenes, right? Up front, it's more like an online banking. It's just a few clicks of the button, but that is what happens. So you could use those cryptocurrencies I described. You could use fiat, because we very much believe in a digital future. There's going to be several digital currencies, digital assets, and they will all be able to trade with each other, which is another reason that tokenization has become so popular. Is people that understand that and want to be innovative leaders and get ahead of the curve. They understand that they want to be in this digital ecosystem. So did that answer your question?
No, yeah, absolutely. And it kind of brings up the, it kind of alludes to another interesting aspect of this because, people familiar with investing, and it'll kind of help bridge the gap into kind of the secondary marketplace stuff, which I want to unpack as well. But from the operations standpoint, and why people invest in this stuff typically is for, cash flows, right? You are someone that's saying, okay, great, we're going to be getting some type of pref return on this investment. It's going to pay out X up to a certain amount. There's a waterfall sometimes do you see this kind of affecting that in some form or fashion, and also kind of how would that work, right? So you're a primary, just to, the normal example is that, I subscribe to a certain offering. It pays out, quarterly prefs to my, how I've purchased it. I take advantage of all the great tax write-offs and everything, get a K1 for the income, and then it sells, refis, or something happens, and then I get my money back in a couple of years most of the time. And it's kind of, certainly differences to any real estate development, but for a large part of the majority of these things, that's kind of how it works. So from that same perspective, does tokenization change kind of the investment like directive from, I get maybe losing the wrong word, but like the impetus for people
Yeah.
to go out and do this? How does that change in this style of structure?
Yeah, it's really a spectrum. So nothing has to change at all. In fact, when I tokenized a storage facility of mine and talked to the investors about it, and the first thing was, "Oh, wait a minute. What does this mean? How am I going to get paid now? How is all this working?" I said exactly the way it is. If I didn't tell you and you want to just continue to receive your quarterly distributions the way you do, then you wouldn't even know that it's tokenized, right? Yes, you have an account and access and all these other things, but it doesn't fundamentally affect, the real estate at all, or doesn't have to, right? It's the same waterfall if you want a waterfall in there, whatever the case. It's all fundamentally the same. The distributions happens in that network, right? So same, it's just it all happens on the platform, all the distributions and everything, because everybody has their own account. So nothing has to change. It can operate exactly as it did before. Now, let's go to the other end of the spectrum and say, well, what can change? What maybe are some enhancements or benefits? And one of them we've talked about, and that's the fact that you don't have to wait for the sponsor or syndicator to sell the property or refinance the property to start realizing, your actual returns. That after 12 months, in this example, you can actually take control of that and potentially sell some or all of your position when the syndicator doesn't do anything. Moreover, it doesn't put pressure on that syndicator to sell or go refi. I mean, if you tell your investors, hey, this is probably a 5-year hold, and you go 5 years down the road and it's not a great lending environment, not maybe a great real estate market, they may feel pressure to get in and sell that investment. Or if it's cash flowing really well and you'd love to just stay in it, same. They may feel the pressure to sell that because it's the only way that their clients or their LPs, their investors, can gain liquidity. So that's changed. The other thing that we will see change in the future is you will actually be able to get distribution, like maybe, in fact, I know, for example, like Grant Cardone, some people, that's a bad word, some people love him, doesn't matter, I'm just talking about his business model. He has one where he will pay distributions in Bitcoin, for example. And so you will see that digital intermingling of those assets be where somebody could do their distributions in some type of crypto or some type of stable coin. That's another popular one. And that just allows people the flexibility to play in the digital asset world as well as the traditional finance world and really bridge those gaps more and more. So that's the other end of the spectrum where you can really get heavily involved in the digital aspects of it.
And does this kind of platform also help to streamline things as far as a reporting standard? Because the thing I kind of see, the primary one, again, it's all relatively the same. Again, to your point, I think it's a great point. Like, if you're just doing this, like, you might not even know, right? Again, like, things are going to look a little bit different, but you sit there, you receive your fiat, you run it out for 4 or 5 years, you get your money back, right? It can be that simple and that, similar to what we're normally used to. But from like the GP side of things, is it, obviously, you have to issue K1s to all of your investors. Does this type of restructuring, or just kind of like how this technology plays into that, is there kind of a streamlining? I'm assuming there probably have to be, especially on the secondary market, for the reporting to the investors of the income received.
Yeah, both, from a technology standpoint, and if you're dealing with a broker dealer or a SEC registered platform standpoint, there's just different standards that need to be done. But that's where something like the blockchain comes into play. The SEC still sees the transfer agent as a source of truth, meaning they're going to run the cap table of ownership. But the transfer agent that we use, for example, uses the blockchain as well, right? And so that is a phenomenal way to capture data. And I think the evolution here is in transparency for the investors and everybody else. So yes, records are pretty much automated. I mean, your cap table is updated in real time. So, every day, every trade, what that looks like in your reporting. And yes, our platform does show, the various investor pipelines and things like that. As far as the K1, that's such a good question, and we get all the time. So we would recommend one of the companies that we work with that does a K1, but or distributes them. But let me tell you how this works in principle. So when you have this entity that is a syndication entity, right, whether that's a fund or a syndication, it doesn't matter. You have the entity and they file a tax return with the CPA. That doesn't change. They're going to still file the same tax return with the CPA. Now, the CPA has this tax return, and what they need is all the data of who's owned what amount of that investment and for how long, right? And that's where, to your point, the secondary market, really has a lot to keep track of there, and the blockchain will be helpful because you can see again who owned what asset for exactly how long, because it's all recorded on the blockchain. So you take the data from the tax return and you put it into the software, and it can electronically disperse K1s to all the appropriate owners for the appropriate time frame that they owned it. So if you only own the asset for 1 day, then you'll get a K1 for that 1 day. And that's not something we do, but you could use a CPA we could refer that's familiar with digital assets. You could use your regular CPA, and then there's a firm with the technology that CPA uses to distribute all those K1s.
Yeah, because I'd imagine, at least from a cap table perspective, like, the initial offering, right? Especially if it's a 12-month lockup, nothing really. Again, that's the really kind of cool part about this that I really enjoy is that whenever there's kind of an integration of, very cutting edge technology or things that are still, extremely dynamic in how they work, right? How cryptocurrency did yesterday is not how it works today. It's not how it's going to be tomorrow. A bit hyperbolic of a statement, but again, it's that dynamic, right? It's kind of, the I really view it as like, the Wright brothers taking off at Kitty Hawk, and then, us having fighter jets, 20 years or like 30,
Mhm.
40 years later, we have jets flying around, right? It's like
Yeah.
what was working yesterday is not going to be cutting edge tomorrow. It's not going to be cutting edge the next day. But when you can have that kind of bridge to where you have very analogous structures that don't change the end user perspective a whole lot. That really is, I think, important to help to kind of integrate people into seeing digital assets as really, what's coming. And it is coming, right? It's
Yeah.
not going away, right? It's whether you like it or hate it, it is coming. So the next thing I kind of want to dive into is from the marketplace perspective, because that's really where I find this stuff to be pretty interesting on how I've been involved in commercial real estate for the past 14 years, right? It's all, again, very, very regimented, a lot of paperwork, illiquid, you run it how long it runs. But when it comes to that, is there with cryptocurrency, right? One Bitcoin is worth, 100 and change, I think is what it's trading at right now. But you can buy, $5 worth of Bitcoin, right? You can break that one up into almost an infinitesimally small amount of investment. Does that same kind of fracturing happen on the secondary market? What's kind of the basement? People, in some of the, you know, uh, crowdfunding platforms that have come out, not naming any names, I don't have much of a kind of neutral on it, but it's like, hey, invest in real estate for as little as $5, right?
Mhm.
How small of an investment amount does it go down to? Is it super fractional, or is there something, on that initial offering, right? It's going to be, again, you said it reduces the amount of capital you need, but you're probably not, 5, 10 grand is probably going to be a basement, I'd imagine, on the primary offering. But how far down does that fracture in the secondary market?
Yeah, so I'm just going to take one step back for a visual and then answer that question directly. And so
Sure.
when I think about, tokenized real estate, think about it like a really large gold brick, the real estate. And a really large gold brick's kind of hard to get into, definitely hard to get out of. Everybody has to move the same way. The same thing happens to it, right? But if you take that really, really large gold brick and you break it into 10,000 gold coins, and then each investor is just holding on to the gold coins that they have, that's how we think about this. So let's take a $10 million piece of real estate, for example. So in that case, you've got, let's say, $1,000 per token, and those tokens that are $1,000 a piece is what would be listed in the marketplace. So you could list one token for $1,000. You could list 10 tokens for 10,000, so on and so forth. And that's how it's set up now. We're not actually fractionalizing beyond that because $1,000 is a pretty small amount to be able to get involved into real estate. Technically, yes, you could. The technology allows for it. There's the pieces that you could if you wanted to do a $5 investment or something like that. But the way we're doing it, just to keep things streamlined and simple for everybody, is just individual tokens. and a lot of the projects have about $1,000 approximately per token price. So I think that that's what I would call the entry level that you'll see out there in the early days of the market. And um, real estate being the type of asset it is, I don't think it's probably going to trade as fractionally as you've seen some of the cryptos or things like that. Just like stocks, you can have one stock of a company, but they, normally don't break stocks down fractionally, although that's going to change too with tokenization. So we'll see what the future holds, but that's how it looks today.
Yeah, and I think, kind of from that perspective, just to make sure I'm understanding, is that the unit price for the secondary market does not, or the unit size, I guess, would really, because I guess that kind of brings up another question too. Like, so the
Hmm.
unit size, right, doesn't get, you have that, again, gold bar, it gets broken down into the initial offering. So you have a static
Hmm.
amount of tokens, right? No,
Hmm.
there's no mining in this scenario, right?
Right.
So you have a static amount of tokens, and then those can then migrate to a secondary market. Now, how is the how does this market operate from a value perspective, right? Is it something where it's dynamic pricing where you have a bid ask, or is it
Hmm.
all done on basically just the offering price? You can just say, hey, look, I invested 10,000 or $1,000 tokens. If you want it, it's still $1,000, right? How does pricing play into this?
Yeah, so the token seller is going to choose their list price for it, right? And the buyer will be able to say, okay, here's the cash on cash returns, here's the pro forma, here's the tax return, here's the fine, and they can look and say, okay, if I am buying this token for X amount, then this is what my return would look like. So those tokens could be $1,000 a piece, they could be, 1,500 a piece, they could be 100,000 a piece, right? Depending on the value of the real estate. It's really going to be based on the NOI still. It's going to be based on, if we oversimplify it, listing folks may list it like at a 6 cap or something if we're talking real estate, but they'll actually choose the price that they're going to sell it at, and the buyer can choose to buy or transact or not. And the difference between that, bid ask buy sell right now versus more mature markets like, let's say, the way Coinbase does it or the way the stock exchange does it, is normally there's a market maker in the middle. So you're not actually transacting between buyer and seller. There's a middleman in the middle. And that's good because it supports liquidity, price stability, and things like that. In the very early innings of this marketplace, it is going to be direct buyer to seller. Same, a buyer could put in a bid for a particular price that's not matched up with an ask, and a seller could go and choose to sell that. And that's what the platform does, is it makes these matches in a very automated fashion. But in the future, I think what we'll see, and these conversations are being had out there right now, is a market maker or even a liquidity pool type setup in the middle, and that will add to liquidity and price stability where the bid ask is a little bit more firm. But I think, yeah, in the early days, somebody may list their token at what we'll call a 6.5 cap, and maybe somebody could list in a 5.5 cap, which is a pretty big price swing, and a buyer could choose to do that or make a bid in the middle. So very much a buyer seller supply demand marketplace out of the gates.
Gotcha, cool. So again, it's just to simplify that again, it's not just kind of like an analogous NAV, like arbitrary value of just what's coming out into the secondary market. There is dynamic aspects to it, and especially again, and from what I'm hearing from you is right now there's not necessarily a kind of a more traditional like market maker scenario, right, where you have people buying in tranche and then creating the markets between with a standard kind of intermediary function. Correct? That's true.
Yeah, yeah, you got it. So a buyer is going to take a look at what type of cash flow and distributions are being made on the asset. They're going to take a look at what, probably we call it an IRR, or maybe an annualized return on investment, kind of what the equity projections of that are. And in these listings, it will show what they're listed at, right? What that return would be. And of course, if you were to pay less than what that listed price is, the return would be more. If you paid more, the return would be less, or you can buy it as it is. But the pricing will be based off what the net operating income is, probably some level of combination with appraised values and things like that. So secondary and primary are different. Primary is going to be a little more strict on those valuations, and but the secondary is going to, uh, you know, be a capital market at play, where the seller is going to be able to choose what they sell at, and the buyer is going to be able to choose what they are willing to pay for the type of return that they're looking for.
Gotcha. Yeah, and the so a couple things from the investor standpoint on the secondary market, and I think you mentioned it a few times, but is especially investing in real estate, right? It's they're not publicly traded companies, right? You can't just look at the earnings report, for something coming out, on the NYSE. So from the informational side of things, how is that kind of addressed? Is it just kind of an open portal where they have like to be tokenized, right? You have certain things that you have to abide by for this, kind of SEC compliant marketplace, which you're developing. So how does someone engage to see like, okay, it's great to see a prospectus on something that was funded, a few years ago, but you need to see, hey, what are your cash flows? How are things actually playing out in real time to be able to buy something on a secondary market?
Yeah, so to be compliant, there's going to need to be quarterly updates. And so when somebody is looking at what they want to buy, they'll be able to click in, and not only will they be able to see kind of the original primary data that you were talking about, but they'll be able to see data that's updated to the most recent quarter. And so yeah, just a link, and they'll go through. So any updates, updated financials, those types of things are all available to the investor so they can make an informed decision.
Gotcha. Yeah, because it's and that's part of the reason why you have a barrier to entry for accreditation on these types of things is that there is no data point for the new investment going out. So you have
Mhm.
for the and I hate to say it, but the lay investor, and it's what the SEC actually calls people, but for to be able to make an informed decision to be able to engage in that is you have to be a sophisticated enough investor, or at least have enough money to lose from the standpoint of securities regulations on the new side. So again, it's good that they have that you know visibility from the outside in to determine all that. Now, how much visibility is there in the blockchain itself, right? Because one nice thing about blockchain is that it's a very good self-regulating function of it is that you can check and balance all transactions against everything to make sure no one's injecting fraudulent tokens, or no one's doing things that they shouldn't be. It regulates itself by virtue of its visibility, right? So on these types of blockchains, what kind of visibility is there from the outside in? Do you get to see what the historical pricing of, like, hey, 1234 wallet sold 456 wallet, three tokens at X value? Do you see just the transactions, or do you get more of a detailed ledger when you're looking at the transactional history of a particular tokenized asset?
Yeah, I'm going to answer this from, high level. My tech partner could answer it on a very detailed level, but unquestionably, the transactions and the blockchain data is available to go look at. So somebody could do that. Where I think there's a big difference and departure from crypto is you really have to go look at the blockchain in crypto, because they're unregulated digital assets. There's really nobody holding anybody accountable to the truth of the matter. The difference in a compliant transaction, an SEC regulated platform, is all of that data is going to be provided, like the cap table, etc. And they're legally required to make sure that that data is accurate. So you don't have to go to the blockchain to go look at all of the details and to trust, or they call them trustless systems, what you're seeing and what's going on. There's different level of compliance, SEC compliance involved with the data that you're going to work with on a SEC registered platform. But you could go to the blockchain because these transactions are on chain. The record of them are all on chain. It's immutable. So you absolutely, if you really wanted to, could go look at that stuff.
Yeah, which I think is one thing that, I'm a big proponent of digital assets. And one thing that I feel like for the adoption rates for this stuff to really ramp up and for the general populace to think, hey, okay, let me do the research, let me understand it, let's start putting some capital behind this is regulation. Right now, I am very not pro the government getting their hands in things they otherwise ought not to be. But with cryptocurrency and digital assets, we see it time and time again, the ability of bad actors to just rear their head in an unregulated market. And
Mm-hmm.
effectively, we haven't had any, I think, effective regulation. I mean, we really haven't. You see constantly with meme coins and pump and dumps and rug pulls, happening almost daily, that market needs some cleaning up and some regulation. And I think this is a really kind of interesting primer to digitize something that is very I mean, it's one of the oldest assets that there is, right? People have been
Mm-hmm.
living on the earth, they've been claiming real estate for as long as we've been humans. It's taking something historically so well understood and merging that technology into it. And I think this is really good kind of litmus for how this stuff can be effectively done while still taking advantage of a lot of the benefits of uh, digital assets with the ability to have secondary markets for otherwise illiquid assets, to have degrees of transparency, visibility, and also what's the word I'm looking for, and velocity of trade.
Mm.
Right. So that kind of brings up, another portion of that I'd like to ask you about with these secondary markets is their ability to kind of throttle transactions, right? Because in large stock exchanges such as the NYSE, just pick on that for example, they can freeze trading on something if there's irregular behavior going on, whether it's something crashing in value or irregular, potentially bad actors involved in trading. Is there any type of safeguards for these kind of secondary markets for this to shield the trading activity?
Yeah, I mean, the primary reason for the compliance is to protect investors, right? But one of the benefits of the digital aspect or tokenization, you see this now with the Nasdaq and Robinhood and all of them wanting to tokenize, is the ability to actually trade 24/7 and do that. So this marketplace in the early days is going to operate in a similar function as to say like the Nasdaq, where it's business hours, but ideally, it does move to a 24/7, type setup. And no, I think the free market capitalism is going to, be at play. With the real world assets, this is very different than the pump and dump and the meme coins and all the crypto stuff that may or may not really have anything behind it. These are real pieces of real ownership of real estate. So could somebody go and dump a bunch of their real estate tokens? They sure could, but those are real pieces of real estate, and it would just mean somebody got a phenomenal buy on them. It's not going to affect the whole price of the real estate. The property's still going to put out the cash flow that it puts out. It still has the net operating income and location and all of these things. That it doesn't change like a crypto or even like companies sometimes ebb and flow on the news. These are real world asset pieces that are
Yeah,
tokenized.
there's no incentive for someone to go out and dump a large holding to try to tank a market to get things at a basement bargain price, because
No.
those people are gonna be like, all right, yeah, I'm not selling this because it's still a $10 million piece of real estate. The divorce between the underlying asset class, the underlying tangible asset, and the investment side of things, I think is a really interesting concept, right? Because you have a tangible, real, valuable thing, and what people are doing over here trading it isn't going to affect the interstate that's going right by this this hotel that's been this development that's been tokenized, right? Like, people are still driving by, people are still living in these apartments, people are still moving into a piece of commercial real estate and developing things. What the people are doing behind their computer doesn't affect that. And again, I say doesn't anything can happen, right?
Yeah.
But again, from a very generalized standpoint, that's pretty interesting that you have you know inherently baked in safety nets to that point, right? If
Mhm.
anyone wants to dump a bunch of this stuff, I'll buy for pennies on the dollar.
Yeah,
Like,
yeah, exactly. I mean, it doesn't change the valuation of the building, right? It doesn't
yeah,
change the valuation of the cash flow. Yeah, the sponsor will buy it, or somebody else in the deal, or again, somebody who's lucky enough to be in the marketplace. But it's not going to affect the value of everybody else's tokens. I mean, just like anything, things will affect the value. Interest rates could potentially affect the value. Really high vacancy rates could affect the value and lower the net operating income. So, but those are all fundamentals, not really the speculation game that you see in the crypto world.
well, I think that also brings up a good point that you bring up is that it lets you kind of steer your own ship with regard to what's happening, right? Like, let's say you're invested in the Ohio markets. Surprisingly, right now are very hot for commercial real estate. There's a lot of
Mm.
development going on in the Ohio region, and it's cooling in Florida, right? So if you kind of see some trends going on, or you feel a certain way about a market, it allows you to trade out of that without having large lockups, without having other barriers to entry, and maybe you're not wholly sold on it. I'm assuming that again, you don't have to. It's not a zero sum. Like, you can sell part of it, right, and be like, okay, I'm going to reallocate this other provider up in Ohio is getting big. I'm going to go there. I see rent growth. I see wage growth. I see jobs. I think everything's going well there, and I'd like to get some shielding in my real estate portfolio on a much faster basis at a much lower price point than otherwise in the more traditional real estate markets. Correct?
Yep, yep, exactly.
Yeah, I think that's the kind of really some of the tertiary benefits of this stuff. I think are very very interesting. Now, from the perspective of the investor, right? Do these things have, let's say, any different treatment from a, let's say, a tax perspective than any other type of asset class, or is it still? And again, from my perspective, I have to give the other small disclaimer. I'm not giving tax advice. This is educational purposes only. But from a high level, are there any things just saying yes, these things are treated differently, or is it kind of under the same auspice of you know you get you get long-term or short-term capital gains based on how long you hold it, and things like that. Are there anything specific that people need to be aware of when investing in this type of marketplace?
No, it's going to be just the same as your current tax scenarios when it comes to real estate. So, as we gave the example before of the CPA doing the tax return and the K1s, and same, if you sell a real estate token, then you've got a capital gain potential there, right? And so, yeah, it's going to be all the normal fundamental tax pieces. That's why we're excited for the what we call the DeFi, decentralized finance world, to commingle here with the traditional finance. Because when you can use those real estate security tokens, those real estate tokens as collateral for a loan, right? That's a non-taxable event. We're used to that in real estate, so that will be an exciting feature that's coming in the near future here.
Well, I think there's kind of two aspects of that, right? Because liquidity pools and lending have been something that's been going on for quite a while in the crypto space, in the digital
Hmm.
asset space. And I mean, it's been going on for as long as people have been buying real estate. The Romans borrowed money to buy it, right? It's,
Yeah.
the conceptual aspects of those is really interesting. But where I like the point that you make is that, bridging that gap, because part of the problem in cryptocurrency, especially with liquidity pools and lending, right? You draft a smart contract, and then you have barriers saying, hey, if the underlying is forced sale things, it's all automated. It's really cool stuff. If listeners, if you haven't ever looked at liquidity pools or asset-backed lending in the cryptocurrency space, pretty interesting stuff going on there. But
Hmm.
from that perspective, when you have something that has such dynamic, for lack of a better word, let's call it dynamic pricing. Hesitate to use the word instability or unstable, but the price swings can go pretty wild. And again, that's mitigated by the underlying security on something being a stable coin or a Bitcoin, something that doesn't have crazy price inflection. But again, you have some issues with that stuff happening to where maybe there's more often than not, there's kind of the collateral clawbacks in those markets. Whereas what I see with this having a significantly more price stable digital asset, really opening up a lot more doors, right, for people to utilize the expediency of things that are like, your smart contract, your lending pools for digital assets, but for other asset classes, well, not just based in the crypto space, right? Using these things, having some of those blockchain benefits, but also going out and being able to maybe, expand into other real world assets, which I think is pretty cool from that perspective. Now, is that something that you see coming forward? Like you see like the trajectory of these markets going, or is the ability to write those kind of contracts inherent in these blockchains, or is it more paper like traditional mortgage and things like that?
No, I think it's a digital world, digital economy, same day settlement, various types of digital assets being traded, whether that's digital currencies, whether that's stable coins. We've seen the new Genius bill for the stable coins. Like you said early on, it's not only here to stay, it's one of the fastest growing areas. When you have Larry Fink of BlackRock and you have the Robinhood CEO both talking about how all financial assets will be tokenized. When you have the Nasdaq, making a claim with the SEC to tokenize their entire marketplace. I mean, you need to pay attention. The future is digital, and that's how everything will be transacted. And real estate, I think, is probably one of the best use cases out there for it. Because if you think about it, stocks, crypto, treasuries, all these other things, you could kind of already buy and sell them online. They already had some forms of electronic settlement and stuff like that. But real estate hasn't. It takes months to settle real estate normally. And there's all sorts of, middlemen involved and all of those types of things. Very manual process. But no, not anymore. It will now be able to benefit from the digital era with the quick settlement and leverages technology like blockchain to ensure that of transparency and compliance and all of these necessary pieces to make sure you have a good, stable, and robust marketplace.
Yeah, and I think to that point as well, just how this stuff is going to permeate other aspects, especially cryptocurrency. I've always found very interesting, but the real juicy part of this is kind of where you're operating in is the blockchain technology. What came out of the original white papers for Bitcoin is that publicly available, verifiable, auditable ledger systems are where I really see some cool stuff happening, and especially in real estate too. Part of what this doesn't solve for is the back end of how this stuff is publicly like your deeds, your mortgages, things like that are still very paper intensive. Once we can kind of get more of this technology in those spaces to really create a robust and fluid system for that, I think those are kind of some of the next things that I'm really looking forward to see that happen. Now, the problem with that is that you have to get local governments on board and counties for doing, record keeping and deed transfers and stuff. But when you can start kind of getting that type of technology into the complete vertical of what real estate is, that's when I think it's really going to be a really interesting time to be involved in this space.
Yeah, completely agree.
Well, I think we've covered plenty of interesting stuff for our listeners here today. We could probably, pitch back and forth for another few hours, but my producers like to keep the show to about an hour. So again, I really do appreciate you taking time out of your day. Our most valuable asset is our time, because no matter how creative or new technologies, we can't create any more of it. At least not right now until they invent time travel. So appreciate you being on with us today, Tyler. If you wouldn't mind, if people are interested in what currently is available and what current, if the marketplaces are live and want to get more information to get involved, with you and your outfit at REtokens, how can they best reach out to you?
Yeah, absolutely. On the sponsor side, syndicator side, or anybody that's interested in tokenization, we have a free quick start guide to real estate tokenization on our website. So that's just retokens.com, and they can go download that. And if you're interested in some of the other topics that we covered, you can always email us at info@retokens.com. We've got a great LinkedIn channel where we share some thought leadership surrounding the space. And then we've got a good YouTube channel, which is just at REtokens, where somebody can get some additional educational videos.
All right, fantastic. Well, I really appreciate you being on with us today. This has been another edition of the Alternative Investing Advantage podcast. My name is Alex Burney, and we'll see you on the next one.